Solutions to Assignment 1, Part 2. Okay, we resume now with problem number 10 on Assignment 1, where we have Womax Corp., which had $55,000 in cash at year-end 2011 and $25,000 in cash at year-end 2012. The firm invested in property, plant, and equipment totaling $250,000. Cash flow from financing activities totaled $170,000. What was the cash flow from operating activities? Okay, so we're dealing with information here from the statement of cash flows. And with the statement of cash flows, the basic idea, the basic thing going on is you're trying to explain changes in cash for a firm, and you do that in three general areas of cash flow from operations, three general sections. You have your cash flow from operations, or cash flow from operating activities. You have cash flow from investing activities. You have cash flow from financing activities. And the change in cash would be the sum of the changes in these three areas. Okay, now we have to determine the change in cash, which is very simple. We had cash of $55,000 at the beginning of the year, but we started with $25,000. We had $25,000 at the end of the year. We started with $55,000, we ended with $25,000, so we had a $30,000 reduction in cash, right? So we're going to put a minus $30,000 in for the right-hand side of this. And then we can determine, we know two of these. We know that the cash flow from financing was positive, $170,000. Since the firm invested, just follow the cash, if they invested in property, plant, and equipment, that means the cash flow from investing activities was minus $250,000 because the cash went out. Okay, so from this equation here, we can readily determine then that cash flow from operating activities was $50,000, an inflow. So we would explain the change in cash. They got $50,000 from operating activities. They got $170,000 from financing activities for $220,000, but they spent $250,000 in investing activities, probably additions to property, plant, and equipment, which brought their cash balances down from 55 to 25, a reduction of $30,000. Now, in Part B, if accounts receivable increased by $60,000, inventories increased by $40,000, and accounts payable increased by $25,000, and depreciation expense was $10,000, what was the firm's net income? Well, what we're going to do here is we're going to use the indirect method to construct the cash flow from operating activities, and we'll back into the net income. With the indirect method, which is the only method we're going to use, you start with net income, you add back depreciation, you add any increase in current liabilities that are operating, you wouldn't do notes payable, you subtract any increases in current assets, you would exclude cash. All right, we know the result of that is $50,000. Okay, so we can figure out what we started with. We started with some number, we added $10,000, we added $25,000, we subtracted 60, we subtracted 40, and wound up with 50. Well, I'll show you the equation in a second. The easy way to do it without even writing an equation is just start with a 50 and then just reverse all the signs. Start with 50, add 40, add 60, subtract 25, subtract 10, and you wind up with what you started with. Or if you like the equations, the cash flow from operating activities of $50,000 was net income plus depreciation plus the increase in accruals or accounts payable minus increase in receivables minus increase in inventory. You can just follow the numbers there. Either way, you wind up with $115,000. Personally, I like just starting with the $50,000 at the result. Add things that were subtracted, subtract things that were added, and you'll wind up with the net income. Number 11. Apex Mining Corp. just reported net income of $5 million. Apex reported depreciation expense of $450,000, purchased $5.5 million of machinery, and paid $750,000 in dividends to its common shareholders during the year. Apex issued long-term debt of $1 million at a 6% interest rate during the year. Apex had $100,000 in cash at the end of the prior year, and its working capital accounts, except cash, remained constant during the year. So we're going to be able to exclude the changes in receivables and payables and what have you as we then construct the statement of cash flows for Apex for the year just ended. Okay, I have to go back and forth here a little bit, but let's show you the completed statement here, and then we'll go line by line. I start with the net income, $5 million. I'm in the operating activity section. I add back the depreciation of $450,000, Why do we add that back? Because depreciation is a non-cash expense. It was subtracted on the income statement. Net income has had a depreciation expense of $450,000 subtracted to get there, but that wasn't a cash expense. So let's add it back since we want to know what the cash flow is. Okay. There were no changes in any of those net operating working capital accounts. We were told that, other than cash, none of those accounts had changed. So I just put a 0 in there. You could have just left that out. But we wind up with net cash provided by operating activities. The investing activities, we'll keep that real simple in this class. This is not an accounting class. But we were told that they purchased $5.5 million of machinery. So you see I have a cash outflow of $5.5 million. That's the only investing activity. So I list it as a line item. I then include it as the total. For financing activities, we have the issuance of long-term debt of $1 million. That's an inflow. We borrowed. We received the $1 million. But we paid dividends of $750,000. So our net cash provided by financing activities was $250,000. We started with $100,000. If we compute the change in cash, take the $5.45 million minus $5.5 million plus $250,000, we'll get a $200,000 increase in cash, which takes our cash from the beginning of the year 100, add the 200, we have 300,000 at the end of the year. Now I'd like to just raise one question, and that is, what about the interest expense? We were told here that they issued long-term bonds debt of $1 million, 6% interest rate. You would assume they paid $60,000 in interest, but you'll notice I didn't include that. Interest expense is not a financing activity. So some would say, okay, doesn't it go up here in the operating activities? The answer is yes and no. It's a tricky answer. It's actually a simple answer. The interest expense was already subtracted to get net income. So yes, you're including it. Therefore, you exclude it. That's why I said yes and no. We're not ignoring it, but yes, we are. It's not ignored because it was already subtracted to get net income, and that's what we're starting with. So yes, it's already taken into account. Let's say it that way. Okay? All right, number 12. Bailey Corporation's financial statements with dollars and shares and millions are provided here. Okay, for the year ending 2013, we have sales, operating expenses exclusive of depreciation, giving us EBITDA, minus depreciation, giving us EBIT, minus interest expense, giving us EBT, minus taxes, we get net income. Here are the dividends paid. And here's the balance sheet, and you can take a moment and pause this and take a look at it if you'd like. I don't think you need me to read you every number and every category title. So there's the balance sheet. And notice you have 2 years, 2012, 2013. The income statement was for the year 2013. What was net operating working capital for both 2012, 2013? Well, these are relatively straightforward calculations. We did one in an earlier problem in part 1. Net operating working capital is current assets minus the current liabilities net of any notes payable. For 2012, it's $44,000. For 2013, it's $53,725. And if you'd like, you can pause and go back and verify these. Perhaps it'd be helpful if you printed out those statements as you work this. I don't think you need me to scroll back and show you where all those numbers come from. They all come from, I will scroll back. They come from these items in 2012, 2013. Here are your current asset amounts. Here are your total current liability amounts. And here are the notes payable that we are subtracting out of the current liabilities. Okay, so that's where we get the net operating working capital for 2012, 2013. And now we're asked to compute the free cash flow for Bailey for the year 2013. And the formula for free cash flow, and there, by the way, there were a number of formulas we could use for free cash flow. I've chosen one of them. We'll just stick with this one for this class. So it's EBIT times 1 minus T. You add back depreciation. You subtract the amount that's spent on fixed capital, property, plant, and equipment, and you subtract any increases in net operating working capital. All right, if we go back to the income statement, EBIT was $39,000. Not EBITDA, EBIT, $39,000. We were given a tax rate of 40%, I believe. Yes, so 1 minus t. Should have pointed out while it was there, but the depreciation on that income statement was $5,000. Now, how did I get CapEx of $8,000? That wasn't given. Let me walk you through that, and you may want to scratch some numbers down here on a piece of paper. If you're taking notes, just write it off to the side here. Okay, let's go to the balance sheet. Notice that net plant and equipment went from $47,000 to $50,000. So one might argue, no, it increased by $3,000. But keep in mind, the firm has depreciation. Here's how I like to think of it. It's an easy way to remember it. Suppose the firm had spent nothing during the year. Let's suppose, it's not the case, but just bear with me a minute. Suppose the firm spent nothing. What would net plant and equipment have been in 2013? It would have been $42,000 because of the $5,000 of depreciation on the income statement, right? So if they had spent nothing, that would have gone 47 to 42. Well, since it went to 50, that difference between 50 and 42 represents the $8,000 that was spent. Okay? We subtract increases in spending on CapEx, and then we have to subtract any increase in net operating working capital. It went from $44,000 to $53,725. That increase is a cash outflow. So we subtract it, and we get free cash flow for 2013 of $10,675. 13. We're going to kind of return to one of the problems we did in part 1 a little bit and just add a few little wrinkles to it. Herman Industries is forecasting the income statement shown below. The CEO would like to see higher sales and a forecasted net income of $2.5 million. So while they have an income statement down here with net income of $1.32 million, CEO is clearly under pressure or just highly ambitious, wants to grow net income to $2.5 million. Okay? Now assume that operating costs, excluding depreciation and amortization, are 55% of sales. So if you took this item over sales, it's going to be at 55%. And the depreciation and amortization and interest expense will both increase by $10,000. So depreciation will go from $800,000 to $880,000, interest expense from $600,000 to $660,000. Okay? We're going to then note that the tax rate is 40%. That's going to stay the same. What level of sales would be needed to generate $2.5 million in net income? Okay, given the net income and tax rate, then we want to compute EBT. Well, we know that given net income, we can divide by 1 minus t. Remember that from part 1. We derived that real briefly. Take the 2.5 million, divide by 1 minus 0.4, and we get EBT of $4,166,667. So now I've kind of started at 2.5 million, and we've worked up to EBT of $4,166,667. Well, we already know interest expense and depreciation are going up by 10%. We kind of called those numbers out a moment ago. Interest expense will go from $600,000 to $660,000, depreciation from $800,000 to $880,000, and that allows us simply to creep up the income statement up to the EBITDA point of $5,706,667. But now how do we go from EBITDA to sales? We've got to use that relationship that operating costs are 55% of sales. Well, if that's the case, then the result, EBITDA, is 45% of sales. Let's go back here a second. If operating costs are 55% of that number, the residual is 45% of that number. That's all I'm saying there, right? Well, let's just write this formula out as an equation then. EBITDA equal 0.45 times sales. That gets us home free then. Divide both sides by 0.45, and we get sales as EBITDA over 0.45. Take the EBITDA, divide by 0.45, and we have sales of $12,681,482. I went ahead and completed the table computing the operating costs. Okay? Filing number 14. Financial information for Panther Corporation is shown below. We have everything again in millions of dollars. We have income statement for 2012-2013. And we've got balance sheets for both years. What was net operating working capital for 2012-2013? Well, we know the calculations. We're just repeating what we did in problem 12. So I'm going to move a little bit briefly. You can slow it down and just maybe perhaps work this and check your numbers as we go. So I get net operating working capital of $210 million in 2012, $192 million in 2013. We can see that it actually decreased, not increased. Part B, what was the 2013 free cash flow? Well, again, it's EBIT times 1 minus T, add back depreciation, and then subtract the CapEx and net operating working capital. I'm kind of spelling out that equation that I would talk to you through last time, that the gross CapEx is not just the change in fixed assets, you have to add the depreciation. So if you want a formula for it rather than just reasoning it out, there you go. It went from 250 to 300, but we add the 30 that was the depreciation on the income statement, because this understates. Going from 250 to 300 understates how much was spent, because the 250 would have gone to 220 had they not spent anything. Well, therefore it went from 220 to 300, which is 80. Notice I'm putting everything here in millions. The increase in net operating working capital is actually a decrease, minus 18, and therefore the free cash flow is 150 million times 0.6. That's EBIT times 1 minus T, plus the 30 million of depreciation. Subtract off the 80 million of CapEx. Subtract the negative, the decrease of 18 million, so it's actually adding 18 million, and we get free cash flow of $58 million. And this ends part 2 of assignment 1. Well, as soon as we answer the last question, apologize, I forgot about part C here. How would you explain the large increase in 2013 dividends? Well, that large increase can most likely be attributed to that large increase in free cash flow. Remember, free cash flow went up $58 million. So the free cash flow in that year, since free cash flow represents the amount of cash available to be paid to stockholders after the company has made all investments in fixed capital, new products, and working capital necessary to sustain the business, that amount could be paid out as dividends. That's how we'd explain it. And now this ends part 2 of assignment 1.